Hello everyone. We're from Group 5. We are here to present our discussion about case study number 1, Orion Electronics. Before we start, we would like to apologize. One of our members cannot attend to present her part of the presentation. And that is Aurelia Azzahra because she has kegiatan KKN, so she could not attend this presentation. Okay, before we start the presentation, uh, maybe we would introduce ourselves. Uh, my name is Abil Firmansyah with the last digit of name 172.
My name is Tsubasa Putra Tanaka, last digit of student number 103.
My name is Desak with student number 144.
My name is Viona with class 2-digit number of my student ID is 180.
Okay, now let's jump to the case description. Tsubasa, the time is yours.
Okay, thank you, Bogiex. So I will describe the case. So Orion Electronics is an electronic distribution company that sells televisions, laptops, mobile devices, and household appliances through a network retail store and an online platform. In 2026, management pursued an aggressive growth strategy built on three main initiatives: expanding the product range, offering longer credit period to corporate customers, and opening two additional distribution centers. And these are the financial and operational informations of Orion Electronics. And this strategy drove substantial revenue growth, and senior management described it as a success. However, behind this revenue growth, the finance directors became concerned as the company cash balance declined while short-term borrowing increased sharply. Several underlying issues emerged behind this growth. First, inventory built up because management anticipated strong demand for newly introduced product, while several older electronic products became difficult to sell. Inventory turnover fell from 6.5 to 4.8 times, while inventory days increased from 56 to 67 days. The second one, management extend credit terms for corporate customers from 30 days to 45 days, but number of customers are now paying significantly later than agreed. Receivable days increased from 30 to 47 days. The third one, the purchasing director successfully negotiated longer payment period with major suppliers, but one supplier has threatened to withdraw its early payment discount. Payable days increased from 38 to 55 days. The fourth one, the two newly opened distribution centers are still opening below capacity. Total asset turnover declined from 1.8 to 1.5 times. The last one, no impairment or inventory write-down has yet been recognized for the slow-moving stock. Okay, that's the case descriptions, and for the questions will be answered by my friend.
Okay, so I will answer question number 1. So what does the change in inventory turnover and inventory days suggest about Orion's inventory management? So before we answer the question, we need to define inventory turnover and inventory days itself. So inventory turnover is how many sells and restock its entire inventory, while inventory days is how long on average a product are sit or stay in their in the company before it's sold. So in Orion in 2025, we know that the inventory turnover is 6.5 times, and the inventory days is 56 days. So uh, they the Orion cycle through the stock every 56 day, and in 2026 the numbers drop, especially the turnover from 6.5 times to 4.8 times, and the inventory days rise from 56 days to 76 days. So Orions, not only they are slower in selling their product uh, compared to last year, but they are also slower than the average in their industry. So they are slower than their competitors too. So why is this happening? Uh, in the case there are some information that are Tsubasa mentioned before. The first one is inventory build up. uh, Inventory built up because management anticipated strong demand for newly introduced products. So Orion uh, accumulate a lot of product because they expected uh, there will be a demand for their product. So the demand hasn't fully realized yet. So that is one of the cause of Orion built up stock. And then the second one is uh, older product older products have become difficult to sell. So not only that a new stock that they anticipated for a new demand is piling up, but also the old stock that are difficult to sell are also piling up. So this cause Orion's uh, inventory turnover and inventory uh, days worse than uh, last year or their competitor. And so Orion is holding more inventory than it can sell, and part of it, especially the old stock, may never get sold at full value. So the cash that Orion could spend on something else now stuck on the product. And the second question is, what does the increase in receivable days indicate? So we in the increase of receivable days, we could see from a positive and negative interpretation. So the positive interpretation is management deliberately extend credit term from 30 to 45 days to attract more corporate customers. And this contribute to the 25% revenue growth of Orion's. And some increase in receivable days can therefore be seen as planned trade-off to generate higher sales. Uh, and there are also two negative interpretation, which is the actual receivable days, 47 days, exceed the stated policy of 45 days, and some customers are paying after 60 days. So this show that the collection are weaker than intended. So they have a poor credit control and rising risk of bad debts. And the second interpretation is the longer receivable days mean cash is tied up in unpaid customer accounts. So this will explain why operating cash flow fell from 9 million in the previous year to 3 million in current year, despite their higher revenue. So this shortfall forced Orion to rely more heavily on short-term borrowing, which rose from 6 million in the previous year to 18 million. And that's all for question number 2. The next question will be answered by my friend.
Okay, thank you, Bogi. So the third question actually Aurel's part, but here I am to present the Aurel's part. So question number 3, has the increase in payables days improved Orion's position? Discuss both the benefit and the potential cost. So as we know, the increase in payables day from 38 days in 2025 to 55 days in 2026 compared with the average industry average of 42 days indicates that Orion is taking longer to pay its supplier. So we can see from both sides, the first one is the benefit. So from this strategy, the company can retain cash for a longer period, which can help improve short-term liquidity and reduce the need for additional borrowing. But there's also potential cost. That is, delaying payments too much may damage relationship with suppliers, and one supplier that has already threatened to withdraw early payment discounts. Therefore, Orion may lose valuable discount and potentially face less favorable supplier terms in the future. And here are question number 4. What does the decline in total asset turnover indicate the company's expansion? So the decline in total asset turnover from 1.8 times in 2025 to 1.5 times in 2026, below the industry average of 1.7 times, indicates that Orion is becoming less efficient in using its asset to generate revenue. Although revenue increased from $100 million in the previous year to $125 million in current year, the company assets appear to have increased at a faster rate than revenue. So this suggests that the expansion, including the opening of 2 additional distribution centers, has not yet generated sufficient sales relative to the asset invested. And the fact that the new distribution centers are operating below capacity future indicates that Orion may currently have excess or underutilized capacity. So that's all from the question number 4. Here are the question number 5. Revenue and declined. How can these developments occur simultaneously? So revenue and operating profit can increase while operating cash flow declines because accounting profit does not necessarily mean that the cash already has been received. In Orion's case, this can be explained by 2 main factors. The first one is higher receivable days. So receivable days increased from 30 to 47 days because Orion extended the credit period to customers. And this means more sales were made on credit and the cash was collected later. The second one is higher inventory levels. So inventory increased because management expected strong demand for new products. However, some older products become difficult to sell. It's meaning that cash was tied up in unsold inventory. Therefore, although Orion generated higher revenue and operating profit, a significant amount of cash remained up in receivables and inventory. And it means delaying payment to suppliers help Orion to keep some cash in the short term. But the company still faced a cash shortage. So as a result, operating cash flow fell from $9 million to $3 million. The question number 6. Do you agree with management's claim that the growth strategy has been successful? Support your conclusion using at least 4 indicators. So as we analyze the case, we do not fully agree with management's claim. Because although the strategy increased revenue from $100 million to $125 million and operating profit from $10 million to $11 million, the result show that the growth has not improved Orion's efficiency or financial position. Why? Because here are the 4 indicators. The first one is inventory efficiency decline. As the data in the case, inventory turnover fell from 6.5 to 4.8 times, while inventory days increased from 56 to 76 days. So this means that the company took longer to sell its inventory. The second one is collection efficiency declined. So receivable days increased from 30 to 47 days. So this means that customer took longer to pay the company. The third indicator is asset utilization decline. So total asset turnover fell from 1.8 to 1.5 times. This means that the company was not using its asset as efficiently as before. And the last indicator is cash position weakened. So operating cash flow fell from $9 million to $3 million, while short-term borrowing increased from $6 million to $18 million. So this means that the company has less cash and needed to borrow more. So overall, by analyze these four indicators, we can conclude that the strategy has increased sales and profit, but it has weakened operating efficiency and cash flow. And if the company Orion's continue this strategy, the company might face a greater financial pressure in the long term. Therefore, we can conclude that the strategy has been successful in achieving growth, but it may create financial problems for the company in the future. So it's not fully successful as the management claim. Next, the question number 7 will be answered by my friend.
All right, thank you so much, Desak. And question number 7 asks 3 actions to improve operating efficiency and cash position to fix Orion's cash flow issue and operational efficiency. And we recommend 3 key actions. First, tighten the credit policies and enforce collections. Right now, the collection period has jumped to 47 days, and we need to stop shipping products to clients who are overdue past to 60 days and over a 2% discount for payments made within 10 days. The goal here is to bring receivable days back down to the industry average of 32 days, so the Orions can quickly unlock cash tied up in unpaid invoice. And second, clear out the slow-moving inventory and buy based on real demand. The inventory of Orions holding times has stretched to 76 days, and they need to run clearance promotion to quickly sell off the older stock and convert it into cash. Going forward, the purchasing team must align new orders with actual customer demand to lower the inventory days to the 69 days industry standard. And third, sublease the unused warehouse space and protect supplier discount. The Orion's 2 new distribution centers are operating below capacity, and they need to rent out the excess warehouse space to third parties to cover fixed overhead costs. At the same time, they need to adjust their payment schedule so they don't lose early payments discount from the key suppliers and keeping their cost of goods low. And now we jump to question 8. The question 8 asks for 3 additional pieces of information required before we make a final strategic judgment. There are 3 additional pieces of information we need. First, detail the receivable and inventory aging schedule. The Orions need to break down showing and exactly which corporate clients are overdue past to 60 days, and as well as the SKU level aging report to identify the absolute items and calculate the required inventory write-downs. Second, profitability breakdowns by product line and sales channel. They need to see the contribution margin across the product categories, like TVs, laptops, and appliance and channels. And this will help them to confirm whether extending credit to corporate buyers is actually generating enough profit to justify the tying up cash. And third, the certain debt terms and supplier discount structures. They need to full details on the interest rates, maturity dates, and convenience to their 80 millions in short-term borrowing alongside vendor discount schedule. And this information is essential to help the management prioritize the debt repayments without putting their cash balance at risk. So that's all about answer to question 7 and 8. I give it back to the moderator.
Okay, thank you, Vio, for answering the last question. Maybe that's all about our discussion for case study number 1, Orion Electronics. We apologize if there are if we are ada melakukan kesalahan. And thank you very much. We'll see you in the next meeting.